Yeah, I'll
All
have to
right,
remember to
here we
publish
are with
my.
my friends from Tastynation. I think this is the third one of these that we've done, Mr. Yope, I think. And so it's just want to do it regularly. And the purpose is just to kind of connect.
I ain't from Tasty Nation. I'm from Fort Worth, man.
Oh, okay. Thanks for that, John. Well, the rest of us are kind of users of Slack. Maybe you want to do that. Join us on Slack. So we're always talking about trades and ideas. So John Sklar is a friend of mine who's also been involved in some competitions, trading some options and does some things. So that's kind of how I know him. So the purpose of us getting together is just saying, you know, what did you trade last week? What worked? And what are your plans next week? And then just what you're learning and any challenges that you're faced with. So that's kind of our open end, and the goal is kind of keep these relatively short, because if they go too long, sometimes in the future people don't want to participate because it takes too long. I'll record it and then put it on YouTube and post it on Tasty Nation, or send it to you in Fort Worth, John Sklar.
Yeah, because that's a whole different country there.
Yeah, who wants to go first?
You know what? I'll go ahead and go. I actually was, as you were introducing it, I said, well, I'm just going to listen today, but I do want, so I've been, as you know, Dale, because you've been kind of able to see my account. I don't know if the other guys on Trade Diff too.
No, they're not. They're just on contacts through Tasty Nation. Well, Timothy's in the contest.
Oh, okay. All right. So yeah, so I've been, I'm a new options trader starting early this year, initially under Dale's wing, but now I've gone out on my own and doing all kinds of wacky stuff. So I guess the aha for me has been that in trading options, it's almost like, I mean, you could look at it as if you're trading just regular stocks, and you can get into the stock or the option. You can get into the option a lot cheaper. You can get into the stock, and then you can capture some profit. And I've done very well, as Dale knows, trading Amazon this year. Initially doing diagonal spreads, but then doing vertical spreads, and I've made like almost 15, 16, 17,000 bucks trading Amazon.
Yep.
You know, as if I owned it as a stock. But I've owned it as an option, but I've got the benefit of the run-ups, you know. And
yeah,
so
it's kind of hard to own very much of those big, large underlyings like Amazon if you don't own it through options, unless you're a hedge fund or
right. Yeah, so it's allowed me to access the profits, the run-ups in Amazon without owning Amazon. So I think that's kind of been an aha for me. So riffing on that, I've got all these different sources of information now, different, gurus that say this stock's going to go up, that stock's going to go up. And I don't believe any of them, because as we know, nobody knows anything. But there are kind of trade ideas. So I've been looking at these trade ideas and then seeing which ones I think look good, and then putting some of them on, trying to do a little mini Amazon thing. So I've got now like 30 different positions in all kinds of different underlyings. The thing I like about it is I'm kind of diversified. I'm in a lot of different sectors, so that's good. And so the interesting thing is, as I watch these 30 or 40 positions, it's kind of interesting to watch them because they go up, and like, so one day one position will be up 500, 600, 700 bucks. Probably the max profit's around 2,000-3,000 on a lot of these. So I'm not near 50% max profit, but I'll notice it's up. And then a few days later, that one will be down and another one will be up. So what I've been thinking about doing, I haven't done it yet, is I'm thinking that maybe I should set a target, and a pretty low target, not 50% of max profit, but it might be 15 or 20% of max profit. But if I could take off the ones that go up 500 bucks or 750 bucks, because I've been seeing them, they'll go up 500, 750, then they're back down, and then the other one's up 500, 700. So I'm thinking that what I could do is actually harvest these at 500 or 750 bucks up, and then put some more on, and then wait for the other ones that were down the day that I harvested the other ones to go back up a little bit, And even if I was, I'm not sure what the number is. If I could harvest them at maybe even $200 or $300, but if I could harvest 10 of those a week, that's $2,000 a week. So I'm just playing with all of that right now, and I'm not sure where I'm going with it. And I'd love any feedback that y'all have, but I'm just thinking now that I should just harvest these when they're up a couple $100 and then wait for and move on. So
Yeah,
I don't know.
I have a
$100 a
question.
day was great.
What's that?
I have a question, John.
Yeah.
How,
Well, someone just said how many, a couple $100 a day. What was that comment? I didn't catch it.
I just said that I used to use that like when I was ramping up futures. It's like if I can make $100 in a day, I'll close it. Like
Yeah. Okay. Yeah.
it's 24 hours, $100. Like most people don't make that. And it's just like it's $100. It's just $100 a day. It's like well, it's $100 a week. Hey, cool.
Right.
Like,
Yeah. And if I could do that 10 times in a week, then that's $1,000. So
Yeah.
I'm just playing with all that. John, you were saying something.
how are you using verticals?
Well, that's what I'm doing is I'm putting on vertical spreads on these. So I'm putting on vertical debit spreads. And so, and as you know, if you put on a vertical and if it's a bullish vertical and the underlying goes up, then you have value there that you can harvest.
Are you doing it in the form of like what we call an in-out spread, like one strike in the money, one strike out of the money?
Yeah, although I'm not on these, because I do have some expectation that it's going to move. I'm putting the one strike kind of at the money, a little in the money. So when Dale taught me about diagonals, we were buying the far out part of the diagonal at 70 delta and then buying the close in at 30 delta, the next month's strike at 30 delta on a diagonal. On these, I'm going more closer to the 50 delta on the part I'm buying, and then I will go out to the 30 or even 20 delta on the part I'm selling.
okay, that's how you're getting it to. So they're really like how wide are they? If it's Amazon, I guess they're how wide.
Shoot, the one I had on in Amazon was 200 points wide. But yeah, on these other ones, they could be 20 points wide or 40 points wide, or somewhere in there.
How do you? I mean, why have shorts on at all then? Why not just go long everywhere? Why bother with the?
Because it makes it a little cheaper to, it's a little cheaper than to put it on, and I can put more of them on. So it does cut into my profit, but I can put more positions on. So it's. Yeah.
So you're just writing. I'm sorry. I'm not trying to be critical. I think I'm trying to understand. And so like part of what I deal with sometimes is like, well, if I put on a spread, I feel like I can't take it off until like both sides go in the money or whatever, because otherwise it doesn't make anything. And then sometimes I go like, well, if I wouldn't have put my short on, this thing would have been 5 times as much, because everything goes up at rocket speed today. So
yeah. Yeah,
I think one of the reasons of selling it is you can begin to get some positive theta instead of negative theta. Now, it is my impression, Timothy, that with some of the things where theta is not your primary objective, and you're not afraid of being a buyer of long calls or long puts.
Yeah, because I'm trying new things. It used to be all about theta, 500 to 1,000 theta is what I wanted to have, but.
So you're
with everything going
transition. Up. Yeah. Yeah. And it's actually, Mike has been doing some of that recently, buying some strangles and on a very short-term trade. Now I've asked him, how do you know what your signals are? And I think that's the big and open question. One thing I like about what you're doing, John, is you're kind of doing a survey of all the gurus and kind of checking them out for us to see if there's any merit. So I'm kind of always got your ear. Have you found anything that you thought was interesting or impressive? So you're like trying lots of things. You're like Mr. Experiment. Timothy, you seem to be kind of in transition from, into more of these kind of buying a low priced option and trying to hit something big. Because you're kind of you're kind of an option seller in recovery. And Mr. Yope, I kind of think he's like the master mathematician who's out there telling us exactly how, studying correlation and some faults with it. So we all come from kind of different angles and stuff. And I think maybe if it's me, I'm still an option seller that's, gotten knocked around by it, but am skeptical about really fully making a transition into some other option, but willing to look at it. Mike's been real successful this week actually buying strangles in a few things. I wish he was here to kind of talk about it, but some of his ideas is that some of these underlyings are in a FOMO status. And that's kind of why I was asking you, Timothy, like what would be the signals to tell? FOMO stands for fear of missing out, in case Mr. Sklar didn't know that, but
I did.
You did? Okay. But are there any other signals besides just normal financial metrics that they're just, is there something else to look at? And so I guess a question I have for the group is, one of the things I've been trading a lot is SPX. And one of the things I'm noticing is that the puts are holding their value way far out. So if I'm selling an SPX 8 delta put, and I normally go 50 points out to buy the wing, used to that wing was 5 cents, and now it's 20 cents, 15 to 20 cents. So those far out puts, I guess tail risk, are more expensive now. So I guess I'd like to throw to the group, and especially, Mr. Yote, what do you make of that? Is there any implications of it?
Insurance is still big. Tail risk is still a real thing.
Mm-hmm.
And if you look out there and if you have any kind of metrics about, S&P tail risk on the downside, you'll see that it's elevated. And that's what you're experiencing.
It's elevated even though it seems like the VIX is lower than what it was. I mean, it was closer to 30 and now it's closer to 20. So can you reconcile that?
The VIX is more of an at the money aggregate of IV.
Yeah.
Whereas, something down around 5 to 8 delta, the VIX is not going to include that in its calculation.
Really?
Yeah.
Okay. I have noticed that though, when VIX is higher, I get paid a little bit more for my SPX 50 point wide. There's times where you'll get $1.25, and there's times during low IV that you might get 70 cents or 50 cents. So
yeah, it still affects the whole thing. Like IV is still a good measure.
yeah.
Right?
So I thought John was telling me though that it like VIX wouldn't affect it. So IV would, but VIX wouldn't. So is that what you're saying, John?
I'm not sure. So IV is just another way of looking at price, right? And it's a nonlinear relationship, but price and IV move up and down together, right? We believe that? Then at the money.
Well, normally IV moves
Except
up,
in metals.
moves up when the stock usually goes down. But
because I remember it's implied, right? Implied volatility just basically means it's implied because IV just means overpricedness of an option, right? That's all it really is, isn't it?
No.
I thought it was.
Yes,
You could just yes and no.
Yes. Let me try to explain. In the option pricing model, there is this invisible parameter called implied volatility or volatility, right? There's no way to measure instantaneous volatility. What there is market price. We know price. It stares us in the face second by second. So we take the price, and mathematically we know that price and IV have a monotonic relationship. So that means, if you remember your algebra, you can invert that function and take price into this hidden variable called volatility, right? You can invert that function. So what that means is that option price and volatility, or implied volatility, are the same measure of price. That's just the way it is mathematically. And they have a positive relationship, which means anytime price of an option is going up, so is its implied volatility. Absolutely, that's the way it is.
Well, some of that I don't fully comprehend, but or even partially in some point. But I do know my experience with doing the put spread on SPX is 50 points wide in a higher VIX. I'll get a little bit more for it. On the other hand, the call options, 30 points out, I'm buying the wing for a nickel. On the put side, 50 points out, they're still priced 15 to 20 cents many times.
Yeah, that's the skew.
And that's the skew.
Yeah, because people believe there's more risk to the downside on SPX. On other commodities, it could be on the upside, like metals. But
Yeah.
the implied volatility. So isn't it? So you can slap me down anytime, Yope. But it's super basic. Black-Scholes, like there's the basic price model. Like basically, someone decided options should be priced, whatever, with formula X, and then the amount the price deviates, an option price deviates from Black-Scholes base model, like IV of 0, is then becomes IV. Is that not correct? So if you're off, if you're basically, if the model says that option XYZ strike 100 strike should be worth $5 on like the most boring day ever, but it actually is priced at 7. Right, the delta is $2, and then that works, and then via other black magic math, you end up coming with an implied volatility saying, "Hey, it's expanded." Is that not it? Does that make more sense?
I'm not sure I understand the question, but I'll explain how it works.
Okay. Well, I'm just trying to simplify it. But
we know option price. We can invert the Black-Scholes model, which is supposed to tell us option price.
Yeah.
We start with price, we can invert it to get the volatility that is implied by that price. That's why it's called implied volatility. Silence.
Yeah.
Right. So it measures overpriced, how much something is overpriced.
No.
So an IV doesn't. Well, that doesn't that. It doesn't.
I don't know. I've never understood this option is overpriced concept.
Well, I think what Tasty Trade, when they say that most it's over, like the difference between realized volatility and implied volatility, right? It's kind of like what they expect it to move and then what it actually moves. And I think that's what they always say is the edge, is because usually the expectation is slightly higher than what's realized.
Okay. I think. Anyway, well, I'm not the math guy. I just my understanding is, if, like, for example, if you go into the Analyze tab and crank down IV to 0, right? That should be the base Black-Scholes price that you're talking about inverting, right? The whole inversion. So if it's 0, then you would have the actual model, the one true price that someone has agreed on, that's what options should be valued at. But when people, because it's supply and demand and everything, when people bid up a price, so instead of the model says it should be 5 at IV of 0, but it'll be some other value at a higher IV. So instead of $5 per option, it goes to 7 or 8 or 10 or whatever, and then that's overpriced. Everyone wants that 100 strike. And so people realize I can sell my 100 strike for more and more and more and more, and then it goes up. So that's
If the IV of an option is 0, the price will be 0 according to the model. That's what I think. I've never run that calculation, but I believe that's true. So,
Oh,
but
well,
I
no,
don't,
okay. Okay,
I
I
don't
thought,
understand, I don't understand the utility of what you're describing.
I'm just trying to, I thought Dale here is looking for an explanation of how the IV impacts stuff. Like, I think it's, well, that's my understanding. I haven't ran it through either, but I believe that like the lower the IV, the closer it would get to not 0, but it's going to get to, because well, whatever.
Here's a practical question I'll throw to the group. Is there any way of taking advantage or finding an opportunity in skew?
I don't know of any edge, but it's just what you can. I think it's more. It could be one of those signals. If skew starts changing, you may want to.
Here's what I mean. I mean, you might create a put spread or call spread, and you might choose the one that has more premium to trade based upon where it's skewed. Now, that's just kind of one way that I think, and I don't tend to do that. But have you guys done it?
No, but there's something I'm not sure people understand. You know, Tom says that put premium is expensive and put spread premium is cheap. And he says that call premium is cheap and call spreads are expensive.
Is that because you're buying one of the legs?
What he means is, let's say you're going $10 wide.
Yeah.
For the spread. If you're on the side with the skew, that means the one you're buying 10 strikes further out is more expensive. So what you get for the spread is less.
Is there an easy way to kind of to gauge that quickly? Is it through the Analyze tab or anything else that might help us know when that's occurring?
To determine where the skew is?
I know Tom naturally kind of has that because he's traded it for 50 years. But I'm not sure if I just put on some kind of a spread, I wouldn't be able to identify that just by looking.
Okay.
It sounds like you could identify it just by looking at the call and the put spread and seeing which one.
So looking at the money and counting 20 away and seeing what the prices were, 20 points away on the call side and 20 points away on the put side, then you could make an idea of where the skew lies.
Yeah, that's one way.
Yeah.
That's the general.
So can you, how would you let that affect your trading, or would you? Once you have that information.
It's a rare situation. For example, you might want to know, let's say with Apple or Tesla, which way the skew is, because that's where the juice is if you're selling naked.
Okay.
And you may want to play on that side.
Yeah.
In general, I don't care.
Yeah. Well, it affects me on SPX because I'm looking at where, the nickel wide, because I'm just buying the call side. I mean, I'm just buying the option in order to lower the buying power. So it's not like I'm really trying to affect risk. So consequently, I can get in with less buying power on the call options than I can on the put options, but the put options are worth a little bit more. So anyway, any other questions that you guys would like to throw to the group?
I just want to say that Yop is totally right. I just use Analyze tab to bring IV to 0 and the price went to 0.
Yippee!
So.
All right. It's always good to.
Math wins again.
I just had a misunderstanding of what it was, but I guess it's IV is okay. Then that's weird. But basically it's just the higher the IV, the higher all options prices will be. That's it is kind of one. It is 1-to-1.
Well, maybe.
Yes, but there are some details that Tasty Trade glosses over, and I'll tell you what they are very quickly. Okay. The only thing with an implied volatility is an individual option. That's what the Black-Scholes or other pricing model prices. That's the only thing with an IV. If you look at an options chain and you go to at the money and a few strikes this way and a few strikes that way, you get the IVX, which is a volatility approximation for that expiration.
So do you use individual strike volatility as you place trades, John?
I have at times tracked that, but no.
Okay.
I mean, I'm just using higher level approaches. Like I'm selling put spreads no matter what.
Yeah.
Right. So individual options have an IV. Those IVs are used to calculate the IVX. Everybody knows what IVX is. It's on the right side of the options chain.
Yeah, of an individual.
Expiration or cycle.
Yeah. Okay.
Right.
Right.
And then you can calculate a VIX for, let's say, SPY or the VIX by taking expirations like the one below 30 days and the one above 30 days, doing some magic with the individual option IVs and averaging all of it out. So it's like 30 days. Like if you have a 19 and a 38, you can average that to 30 days somehow, right?
So
that's a VIX.
Let me ask you a question, John. So when you get an IV of a particular stock or underlying, is that not meaningful?
Stocks and underlyings do not have IVs.
So when I bring it TOS and I scan for volatility, I'm scanning for volatility of that underlying and I'm scanning for volatility of the IV rank. So that has no meaning?
Historical volatility applies to price movement of the underlying. That could be what you're searching for.
Well,
Or at the money, right? It could be at the money. I thought it was at the money IV was what they reported sometimes. No?
I don't think so, but maybe.
Okay.
Hey, John, I thought I heard you just say that you're just putting on put spreads. Is that what, did you say that, or did I hear that right?
Well, that's something I do as often as I eat breakfast. I'm selling put spreads and spiders.
Okay.
I mean, that's just like a little cash register.
So can you say more about that?
I have short MES futures for downside crash protection, and I'm selling basically 10 to 15 wide SPY put spreads where the short leg is about somewhere between 10 and 20 points out of the money. So I modulate the width of the put spread and where the short leg is, depending upon, what I see as downside risk. And in the meantime, I have some MES shorts hanging around just in case the whole thing goes to crap and we wake up to a market crash.
So I want to understand a little bit more about that because kind of what I heard you say was that an underlying does not have an IV. So when I'm looking at this in TOS, and you mind if I do a screen share?
No, go ahead.
All right, if I'm doing a screen share here and I'm looking at all of these most liquid ETFs. So these numbers that I'm given in TOS for an IV percentage and an IV that I can scan for, what does that mean then?
Oh, you mean the tosses volatility?
It's giving me an IV percentile of IWM is 22.73 and an IV is essentially 29.
Where's the IV percentile?
IV percentile, the far right one is implied volatility, and this next one is IV percentile. So, and you know, I can just scan this way and from high to low on an ETF, and kind of looking at both of those. And for example, if I'm doing a lot of trading of strangles, I'm looking for things that are higher in both IV percentile. Now that's a little skewed because, as you guys know, we experienced in March a VIX that shot up to 80 or something. You know, I don't remember what it was, but like one year you can see it shot up to 74, 75. So all of the IV percentiles were kind of thrown off as a result of that. So what I hear you saying is that an underlying doesn't have IV. So what is it they're using here? And how is that calculated?
Okay, so yeah, I had forgotten because I don't use TOS very often anymore.
Yeah.
They have created something, an IV for an underlying. It could be they're doing, I'm looking up the help file now, but we can talk about that some other time.
And we don't necessarily have to answer it today, but that's my question. I'm trying to reconcile what I hear you saying, and there's something listed here, and I just wanted to.
All right. So people use the phrase VIX-like calculation, right?
Okay.
I explained before that VIX is attempting to create a 30-day implied volatility, right? A 30-day projection.
Okay.
Right, and the way they do that is they use the expiration that's less than 30 days and the one that's greater than 30 days and average it all together.
Okay.
Okay, so that's not an IVX because the IVX is per expiration. The IV for an underlying would be how that's all put together for a 30-day, just like the VIX. Okay, and I think that's what TOS is doing.
Okay, gotcha. Well, is there anything else? You guys we got really technical, it seems like, in this conversation. Is there anything else that you guys want to throw out to the group about things you're trying to figure out? If not, we'll call it a day and then have another one next week.
I'm trying to figure out why this market was up. Oh, sorry.
Why this market is up? Yeah, I'll take a shot at that. Anybody else want to take a shot?
I think I cut off Yop, so he can ask his question too.
I was just going to say that offline I've been having other conversations about co-integration and pairs trading.
Yeah.
And you'll notice that I put in a post there that I sent an email to Julia about producing a co-integration pairs report every week.
Okay.
So
I'll be anxious to hear her response on that.
Okay.
And yeah, if let us know what you find out. Timothy, the only thing I could figure out, why does this market keep going up, would be the Fed. The Fed interest
Oh yeah, I know.
rates.
Well, I just found out that so Apple has got bazillions of dollars in cash, like literally billions, but they're actually the Fed is buying their bonds. Apple's selling bonds.
Did you see something I posted on Slack about the merger between the Fed and the U.S. Treasury?
Yeah, I've heard about that too on some of the podcasts I listen to.
Yeah, somebody sent me a link to a Twitter feed where a person was talking about that, and there was even some quotes about going back to the gold standard. And I didn't know that anybody was really still legitimately pursuing that, but undoubtedly there's
Yeah, there's a new appointee or something who has that on her agenda.
Right.
Well,
But
I hear all
anyway.
kinds of stuff about not just the gold standard, but asset-backed currency. So it would be all assets.
Oh, in terms of crypto or stuff like that?
Well, no, just for even the, like US dollar and the international currencies.
Mm.
It seems like there's something going on where there's a movement in that direction. Whether we'll get there or not,
I would tend to kind of rate it as low probability if I had to set a betting line on it, but stranger things have happened, like a virus breaking out worldwide. So who knows? I would tend to think that we would have to have really bad levels of inflation, like 1970 levels of inflation, before anybody would consider that as an alternative, but I might be wrong. All right, anybody else? I had the proverbial, usually I interpret 10 seconds of silence, meaning that's all we got today. Anybody else have any
I'll do a little bit of homework, see if I can remember what Thinkorswim was calculating.
Okay, yeah.
Yeah, I'm looking at I'm trying to find I'm thinking this there, but I'm thinking some sort of correlation between interest rates and what the market does, because interest rates are certainly affecting metals.
Mm-hmm.
If interest rates go up, metals go down, like
Right.
almost instantaneously, because the metals are an inflation hedge, I think,
Right.
and people are really worried about inflation, even though it's never really happened. But that's one thing I keep looking at, is to see if the 10-year or the 10 or the 5 or the 20-year interest rates could be a signal. Like if we start seeing that inch up even farther, then that's going to yank the rug out from these guys that are getting these, zero, almost free loans.
Sure.
And that's going to cause a cascade of people that it will not make any sense for them to sell a bond and then buy all their stock back.
Right.
Right. And without buying their stock back, the prices will halt. So it's kind of like, we just need these mortgage-backed securities are great as long as the default rate doesn't pass 5, right? So I think it might be something similar, but I don't know. I'm grasping at straws.
Yeah. Well, let's keep the discussion, and Sklar, join us on Tastynation if you'd like. We're always kind of sharing ideas, and I'll send you the link if you don't already have it.
Okay.
Join us over there. We'll continue this discussion online, and let's talk on Slack. If you guys, when Drew's ready for the next one, maybe next week or so, we could do another one. Thanks for your time, guys, and I'll post this on Tastynation as I get it set up on YouTube.
Okay, thanks.
All right. Talk to you guys later.